I'll just give a background of the market, probably how we are thinking at today's point in time. Of course, the valuations are stretched, but this is not something which is unique for the Indian equity markets. If you look at the equity markets globally, they have done well in the past 3 years, especially since COVID. There has been liquidity and there's been strong capital appreciation, which also made new investors coming into the market. So this is something which we have seen across the global markets, that the equity indices have done really well. So valuations are definitely trading at a premium to their 5-year or a 10-year average. But if I look at India per se, in terms of the growth, India still remains as a shining star in the global economy, whereas the current outlook is that the developed markets could see a downturn because of the higher inflation. Thankfully, it hasn't happened, but the view which people had 6 months ago was that the developed markets might see a downturn, whereas India, it's been a steady growth in terms of mid to high single digit GDP growth, which we have witnessed so far, and the inflation is well under control. So you have certainty in terms of the growth prospects, and you don't see any headwinds in terms of for the growth per se. That is why I think the valuations are also trading at a premium. But in this meeting, probably I would discuss mainly on the technology fund. This fund became live in September, so it's a 7 months old fund now. So if I have to take a top-down view, let's say, why should one invest in technology? Why should an investor consider investing in technology as a theme? If you look at it, then probably, like Sir mentioned, we consume more technology than food today. So if you look at anything and everything which we do today, be in terms of how you access the bank, or how you buy your grocery, how you buy your apparel. If you look at anything which you do today, and if you compare it with how it was done in our parents' generation, or let's say even 10 years ago, you could see a significant increase in penetration of technology across vectors. So probably this is one theme which is universal. We have seen an increase in technology spends. I think that is the main driver. And second, if I look at the Indian IT services space, because the major portion of the investable universe is IT services, and if I look at the Indian IT services over the past 2 decades, this has been a consistent growth journey. So the growth has been pretty strong. This has been contributed in an enormous way to the Indian GDP, and it's been a absolute employment generator, etc. So this has been a growth story, and Indian IT services has outperformed the global IT services over the past decades. So first, technology penetration, and second, we have a successful story in Indian IT, demonstrated story. So that also is one of the reasons why one should consider investing in technology. And three, if I look at digitalization in India, so apart from the services spends, now we have companies which are listed in the public space which cater to the Indian consumers. Be it a food delivery app, or be it an online ticketing app, you have firms which are born out of India, and then they are serving the Indian consumers. And we all know this is something which the penetration has been improving over the past 10-15 years, and we see scope for this to improve based on how we are today relative to the global points. I'll give you some data points on that. So these are probably the main reasons from a medium term perspective why one should invest in technology. Increase in penetration, 2, a well demonstrated success story in Indian IT, and 3, digitalization in Indian internet space. I think these 3 are the main stories. And 4th point, why now? Why should we invest in a technology space now? I think this is where the valuations come into the picture. Like Sir mentioned, this has been an underperforming sector. Probably I would say in FY23 it was underperforming. FY24 it was more or less in line with the market. So the sector hasn't outperformed in the past 2 years per se. And this is a sector which has very strong fundamentals. So if one takes a medium term view, then probably this is a time one can start accumulating interest in the space. I think these are the main reason why I would say one should consider investing in the fund now. Probably I'll just throw you some details. So first on tech spend, I think I mentioned the first reason is the increasing penetration. You can see here, we have tried to give you some examples of, let's say, banking. 2 decades ago, if you want to open a fixed deposit or if you want to open an RD, if you want to transfer funds to someone, you have to visit a bank. Now you can do it through your digital app, mobile app. Similarly, if it's a payments, earlier it's cash or check or DD, but now UPI is more universal and it is getting global. Similarly, if you look at retail, instead of physically buying from stores, you can buy it through your e-commerce apps today. Manufacturing, if someone has visited a manufacturing shop floor, let's say 2 decades ago and probably now, one can appreciate the increase in robotic automation or intensity of automation in the digital, in these factories. So, and in capital markets, for which is very relevant for our world, it's a 2 decades or 2.5 decades ago, you had physical shares. Now everything is dematerialized, which is nothing but a tech form. For people in the generations to come, the impact of technology which would be much more than what we are experiencing today. For example, during the COVID era, it was, the online courses were become like something which is very common. So we used to go to schools and colleges for anything and everything. Now if you want to upskill or reskill, it's through the online courses. So for the generation to come, the impact on technology would be much more than what we are experiencing today. For them, it will be digital first rather than physical first. Even if you look at government, it's not just the big corporations, it's the governments also which are moving towards digitalization initiatives. You could see that all the Narega benefits or anything in terms of direct benefit transfer, it is done digitally today. Nobody goes to the ration store or anything and probably get the payments. Similarly, healthcare. Nowadays we are visiting, this is still a very nascent area, especially in India. But if you look at the impact which it can have, technology can have in the next 2 decades or 3 decades, the proportion of people who would be using telemedicine, I think that will go up. Advertising, I would say this is one of the favorite examples for me. For example, if someone wants to get our attention on our problem and probably want us to use their products, let's say 2 decades ago or even 10 years ago, then one has to, the most common way is billboards in the highways or buying prime time ads in TV shows. Nowadays, nobody wants to do it because if everybody wants to catch your attention, they can serve you personalized ads through the digital modes, through your phones. Whatever pages we browse, we always get annoyed by those ads, but those are more personalized than what people were doing. Let's say it's still prevalent, but I'm just saying the I would say the interest, I would say, or the return generated for an advertiser through the digital channel is much more when compared to the traditional channels. That is why it is getting accepted. And finally, probably this is a physical meeting which I am doing after a long time, because it's usually happens nowadays seamlessly through web calls, etc. So the tech has also reduced the need for such physical meetings. So in a simple way, you could see that tech is something which is getting integrated into each and every thing which we do in our life. So then the next question should come. If this is something which is already happening, then is it showing somewhere? The data should always reflect that. If you look at, we tried to do it from 2 points of view. One from a country's point of view and 2 from industry's point of view. If I look at US or India, you could see over the past 2 decades, tech spending as percentage of GDP has moved up. And we have taken US banks as an example because they are large spenders on technology. If you look at the US banks tech spends as percentage of revenues, it has almost doubled in the past 15 years. So the data is clearly saying that tech penetration is improving. And it would be the same if you look at a car's cost today, 50% of it accounts for the components which are related to tech, your infotainment system, etc. Whereas Indian retail transaction, UPI is now around 90%. And e-commerce penetration, if you look at the top right chart, you could clearly see India's e-commerce penetration today is at 7%. 15 years ago, it was 0. And despite the the higher numbers which are reported by some of the developed markets as well as some of the peers, the number it's been an increasing trend. So clearly, this data also shows that the tech spends or tech intensity is increasing across industries. Then probably the next question. First, we were saying that this is becoming part of everyone's spend, everyone's day-to-day life. And second, we showed the data. This is already reflecting in what the companies or the countries spend. The third question, the markets are always forward-looking. Then if this is something which is already happening, then why should it continue? Why should the growth rates continue at what it was, let's say probably for the past 2 decades? The key reason for this is the competition. I think every industry and every company, the biggest threat, of course, is competition. Where will the new competition come from? And if you look at some of the industries, the new competition is coming from tech-led players. The key examples would be our industry. For example, I have taken banks. You have a new category called digital challenger banks globally. These are banks which don't even have a single physical branch. Every activity you do is done through their digital channels, be it mobile apps or be it their internet banking websites, etc. So they are still small, but if you look at the growth, they have become 2.5x of or 4x in terms of the assets managed in the past 5 years. So they are gaining traction. The other industry where we can see this is direct to consumer brands. So let's say for any consumer brand, even today the biggest moat is distribution. How should I ensure that my product is available in each and every corner of the country? I think that's the only question which every FMCG company or every retail company used to grapple with. But today that is not the question. You have many brands which are called direct to consumer brands. They are saleable only through their online channels mainly, or through their webs or through their own stores. But if you look at the mix in FY22, at least for the direct to consumer brands, 85% of their stores, 85% of their sales came through online channels. So clearly this new category is challenging what is considered as the moat of any retailer probably a decade ago. That you don't have to be present in each and every corner. But if you're available digitally and if you ensure that your products get shipped within the time frame which you mention in your website or app, then probably customers are ready to use. And this is another data to say how the tech companies have increased in terms of influence in the whole market. For example, in the USA, between 2003 and 2023, the tech companies' market cap as percentage of total market cap has almost doubled from 15% to 30%. And roughly, if you could see the top companies in the S&P 500 index, which is a very diversified index, the top companies, you have 6 out of 10 companies from the technology space. So clearly, you could see that the increasing penetration in technology is also reflected in terms of the increase in market cap for the sector. Then coming to the local story, the Indian IT services. I mentioned that India is predominantly a services-oriented tech industry. We don't have much products. So broadly, you could say a tech spending is 3 parts. One is hardware, a computer or your laptops, anything, hardware, and then the software, and then the services. So India is predominantly a services player. But if you look at the services growth in the past 5 years, pre-COVID, and also the expectation for the next 5 years, the services growth is outperforming the total industry growth. Software is the fastest growing segment, which is followed by services. So this is also reflected in the market share of IT services. So if you look at the market share of IT services in the total budget, that has increased from 24 to close to 30% in the past 10 years. And this is expected to they expect it to continue to go up. And if you look at the top line, this is the Indian IT services spending, Indian IT services revenue. If you look at the revenue growth of Indian IT services and compare it with the global IT services, there's not been a single year when Indian IT has underperformed the global IT services spending. So year after year, the companies have gained market share. And despite whatever we read in terms of the companies becoming pretty large, having a $20 billion, $30 billion revenue, but if you look at as percentage of the total market, they are still 1 to 2%. It's still a fragmented market. So size is not a constraint. So if they continue to execute well, I think the market share gains should continue for the companies. Another thing, another common question which we get is that what about the threat of AI or any new technology? Will it make the services redundant? But if you look at the past 30 years, there's been so much technology changes, offshoring or remote infrastructure management or automation, whatever you call. But in all those 30 years, if you look at in all those 30 years, the industry has only outperformed. There's not been a single year when the industry has underperformed. So the changes only make these firms very strong, in my view. The companies, ultimately, these companies are like our companies. They are people-oriented. You don't have a factory which can produce a same set of component which is to a specific dimension or anything, etc. These are people-oriented. So when industry change, people adapt. So that's why I say IT services, you can always relate it to our industry. If some changes come, we reskill ourselves, upskill ourselves and adapt to the new changes. Similarly, this industry has been doing that for the past 30 years. So one more thing I would like to highlight is, I mentioned that it's more a services play, but we are also becoming a software market. It's still small, Indian software as percentage of the total software, but you would have read in papers about software as a services firms, Indian SaaS firms. The number of such firms have only increased over the past 15-20 years. If I look at the past 5 years especially, the number of companies which had $100 million plus in revenues, roughly 800 crore plus in revenues, it was just 5 years ago, and today it's 13. And number of companies with $15 million revenues has also increased. And if you look at our market share, Indian SaaS as percentage of global SaaS, that has also doubled in the past. That is also expected to double in the next 5 years. So clearly, apart from services, we are also entering into new segments such as software. And one other thing which is currently not in favor of the industry, but which has been a tailwind for years is, if you look at the revenue composition, US is around 62%. US is the major market, followed by Europe. US and Europe would account for roughly 90% of revenues. So if an investor wants diversification, that I want international exposure as well, then they can take it through the IT services names. We saw why technology is very important because of increasing penetration. And second, how our industry has consistently outperformed the global industry for the past 2 decades. And 3, the key question, why should it continue? Can't we lose out? I think for that, the key answer is, like I said, this is a people-oriented industry. So talent is the key moat for us, key differentiate for us. If you look at the number of STEM graduates, STEM stands for science, technology, engineering, and mathematics. If someone graduates in such disciplines, then he or she is likely to be employable in the industry. The number of such STEM graduates for India is roughly 3x of US in terms of the annual STEM graduates. So clearly, in terms of supply, India leads. And in terms of stock as well, if you look at the number of people who are employed in the industry, India is close second, next only to US. But in terms of the supply, which is more important for the growth, then India leads by a factor of 3 to 5. And if I look at the US always has scarcity for talent, tech people. This is reflected in the US unemployment rate for tech. You can always see the tech unemployment is always higher when compared to the overall unemployment. And then the next question comes. If you know that a raw material, I meant here the talent, is available in some place and the developed markets are in need of that raw material, what can they do? They can do two things. One, they can import the raw material, which is nothing but giving visas. So you are importing talented people from countries like India to work in countries like, let's say, US or Europe. If you look at the US H1B visas granted to Indians, it was around 73. Like 3 out of 4 people who were granted visas in the US were from India or Indians. And what is the other way? One, you import, and the other way is you go and set your factory closer to the raw material. Or in other words, you go and set up your development centers in India, which is nothing but what we call GCCs, Global In-House Centers, captive centers. Such centers have been growing multifold in the past 2 decades. The number of people employed with such centers have also increased. So clearly the whole world is taking advantage of the talent supply in India through one, granting visas to work in such countries, or two, moving their development centers closer to India. And if I look at what the sector has done to the country, this is pretty much reflective from this chart. If you look at Indian IT revenues as percentage of India's GDP, it was just 2% in 2002, and today it's around 7.5%. And if I look at the exports, which is a more relevant metric because we are exporting services, in terms of India's exports, IT services contributes to more than half. So clearly this is a sector which has been a success story for the whole country. So yes. Then the other one, like I said, the key investable universe for us is the services space, where we have discussed the talent is the key moat. And the other thing is the India story. If India is a fast growing story, India's internet penetration is improving, or India's online shopper base is increasing, then we can also take advantage of those trends in the fund through investing in companies which are probably playing for this market. Like I said, if you look at the internet penetration or online shoppers in India, that's been growing across. This is something which we have seen with our eyes over the past few years, so probably I will not spend much time. Like I said, only one question one needs to understand is, okay, this is something which I have seen so far, but why should it continue? I think that's where the market reverts. Because if you look at this chart itself, India's penetration is 7% today. It was 0% 15 years ago, and is expected to double to 15% in 3 years, CY25. But even at 15%, this penetration is much lower than what you are seeing in some of the developed markets and the peers. So clearly, even in 2025, the scope for increase in penetration is very high, which is what will drive the growth for companies which are focused on these things. Then we have discussed the broad trends, why one should invest in technology. Then, like I said, why now? The timing aspect. If I look at this sector and compare it with the broader market, let's say a BSE 500, if you look at over a long-term period, let's say 10-year period, you could see the revenue growth, return on equity or dividend payout ratio, everything has been superior. Leverage stands for the amount of debt in your balance sheet. So clearly, the leverage is very low, which is favorable. So on almost all the metrics, the sector looks healthier when compared to the underlying universe. And if you look at the dividend yield is around 2% now for the index, which is roughly 1% for the broader index, let's say the BSE 500. So clearly, on all metrics, the sector looks superior, and which is reflected in the premium or discount. So this chart is the premium or discount of BSE Tech, which is the benchmark for us, to the broader index. So you could see that the sector has almost always traded at a premium. So we can think, when do we pay a premium price to a product? only when we know that the product quality is superior. That's why we pay a premium product. So in the previous slide, we have seen that the fundamentals are healthy. I think that is what is reflected in this superior valuation. And this chart is more a 1 year forward PE, like we have discussed for the whole market and also the sector. The sector is also trading at a premium to the 5-year average. But if I look at what is the historical premium to the broader market, and then how is it is trading, probably we are closer to the average premium. So clearly it's expensive relative to its own history, but relative to markets, it's not expensive. So probably one final slide before I get into the details of the fund. So we have discussed so far why it's a multi-year theme, why technology is a multi-year theme. But we have also said in the beginning that this is a sector which hasn't done well, especially in the past 2 years, which hasn't outperformed. So if it's a multi-year theme, why did the index underperform? So the answer to that is, like I said, IT services is the major component of the benchmark, and IT services is an export-oriented play. And clearly today, the developed markets are not in a favorable situation in terms of economy when compared to what they were, let's say, in 2021 or 22. You could see here from this was a 6-month-old chart, but if you look at, let's say, the global economy or the US economy, clearly 2024 was expected to be a year of slowdown when compared to what we have seen in 2022. So clearly the lower growth in the developed markets is something which is impacting the sector in terms of their growth rate, which is reflected in the underperformance of the sector. So let me introduce the fund. The fund will invest at least 80% of its AUM in tech and technology related companies. Broadly, it refers to IT services, software, telecom, media, and then internet companies. So these are the broad sectors where the fund will invest. And of course, 20% there is leeway to invest outside the core as well. So in terms of the investable universe, we can invest in roughly 121 companies. And there are new firms which are coming up. This is only for, and in terms of the number of companies, it is still dominated by IT. And it is dominated by the large cap. So the investable universe is dominated by large cap, with roughly 75% large cap, and then 15% mid cap, and then 10% small cap. And this is what I was talking about. If you look at the performance of the BSE Tech Index and compare it to the BSE 500 Index from FY 2008 till FY 2024, probably in 11 out of 16 years, the sector has outperformed. But in recent years, it has underperformed. FY 24 was broadly in line. It was not an underperformance. But if I combine 23 and 24, it has still underperformed. So from a long-term perspective, the sector has been a clear wealth generator. Whereas in the near term, the sector hasn't done well because of the global economic situation, the concerns that it will slow down. So this again relates to the same thing, like 1 year and 3 years, the sector has underperformed, but 5 year, 10 year, and since inception, the sector has done well. So this is the benchmark. The weights are as of July, but this is a slightly skewed index with the information technology contributing around 80% of the weights, the rest by telecom, media, and consumers. Apart from this, we can also invest in the India internet names. So that's pretty much it. So if I have to probably summarize, like I said, 3 reasons why one should consider investing in technology. 1, we can see around ourselves, the penetration of technology is only increasing, and that is not going to change. And 2, you have a demonstrated success story in terms of Indian IT, which has done consistently well for the past 2 decades. The timing perspective, clearly there are near-term headwinds, but if one looks at the long-term performance of the sector, all the ratios are healthier, and there is a superior dividend yield currently trading at reasonable valuation, I would put it. So if one takes a medium term view, then this is a time one should start adding the sector. Whether I will stop here for questions.
So tech might last quarter but next month stocks
Okay, I'll not discuss stock specific things, but let me put it this way. See, like I said, the sector has been, I mean, in terms of the growth, there has been challenges, and this is something which is pretty well known. That the global economy, there are concerns, there is slowdown, etc., etc. So, what as an investor or what the market always looks at is what is likely, let's say, from a 1 year perspective or a 3 year perspective in terms of what the company can do. So, in this business, I have mentioned it already. So, this business is similar to our business. A good person, a capable person at the top, well supported by a strong team which can execute, can always make a difference. So, if there is a belief in the market that a company has a good leader and then probably has a good team, then it always gets rewarded. So the thing is, this is true for any services firm. The management always plays a key role. You could look at the history of the turnarounds in IT services, because unlike a product, in terms of services, it's more about delivery, how you deliver or how you execute. So clearly, the people at the top who has the strategy and people who are at the T-1 level, who does the execution, if there is belief in that, and then of course the market rewards that. Yeah, I'll just take this.
In technology fund, you are holding Z Entertainment and Media and would like to know the question.
Okay. So the sector, I think I mentioned here, probably tech, media and telecom and internet. So these are the investables names for us. And that's why we have invested in this names in the media space as well. Ma'am.
So, as you show your portfolio, there are top two stocks are almost 37% of your portfolio. Top five stocks almost 62% of your portfolio. So is it because of the index constituents?
Okay, it's because of what we saw probably a month ago. That is what is reflecting. But in terms of how the weights would be, there is nothing fixed in terms of what's the allocation towards large cap, mid cap, small cap, and what's the allocation towards tech, media, telecom, and internet. There is nothing fixed. Wherever we see value, we will go and add that. But at this point, yes, of course, the valuations are relatively in favor of large caps when compared to mid and small caps. Mid and small caps have delivered very good returns. There is no doubt about this. But if I look at it from absolute valuation perspective, definitely you see downside protection in large caps, whereas what is there in the portfolio is because of what we see in terms of the upside, what we see in those stocks.
Sir,
Yeah.
would like to know the view on hidden risk of market timing.
Sorry?
Would like to know the view on hidden market timing. Hidden risk of market timing.
Hidden risk.
Of market timing.
Someone wants to do market timing, and if someone is doing market timing, what are the hidden risks are there?
Okay, I'm sorry, I'm very bad at timing. Let me put it this way. It's very difficult to time the markets. So we have been advocating, I'm sure that is what we have been saying is like time spent in the market is more important than timing the market. When you want to catch the bottom, because this is people driven, right? At least the market. So if everyone shares things that this is the market, this is the bottom for the stock, when it gets there, there would be plenty of people who will come and buy. So probably some would say +2, 100 +2 is the bottom for me. Then probably the stock will never get to 100. So it's very difficult to time and probably if you have a fundamental view that this in one stock or one sector, you see challenges at these valuation, then probably don't enter, or you can trim or exit. But if you think the valuation is reasonable, but probably I would want an attractive valuation to get entered, the best way is like start adding, and if you get a better valuation, add more. Otherwise, it's very difficult to probably get the get the perfect bottom. That's what I feel.
So,
Yeah.
after 5 years, can we expect doubling the NAV from currently?
We don't give any guarantee on returns, but the hope is always to deliver superior returns per se. I think last 6 months we have been better than the benchmark. It's a function of the market, the sector, etc. So the hope is that there will be a consistent performance. That's what I can guarantee.
Bala sir, it's a close-end meet, like, so you can little open up. Don't worry on that side.
Okay.
The whole idea is basically getting, in general also you can say in terms of as an IT, because you gave a valid reason in terms of the last 2 years we haven't done well, as a sector haven't done well. So if someone comes to maybe, and if you allocate incremental money, clients, what is the probability that the doubling of NAV can happen in next 5 years or 6 years? Mota return could be 14-15%, not more than that, right?
Yeah. Doubling.
Is that can be one can be really optimistic in that way, or it's too much to expect? Sort of.
Sure. So let me think about the sector. If you look at the growth here, let's say, I'm sorry. Yeah. This one. This is global industry projections. I think we have taken it from Gartner. This is the dollar spending. So the expectation is that the industry can grow at 10% dollar CAGR. And even if we assume that the Indian IT services have always grown ahead, even if you assume that there is no market share gain and we grow at the pace of the market, then probably a 10% dollar growth. And historically, if you look at the USD INR depreciation, that's been around 3%,
Correct.
Roughly 2.5 to 3%. Year to year, it will differ, but over a period of time, it's around 2.5 to 3%. So that will make it to 10 plus roughly 3%, 13%. And on top of it, I mentioned that the dividend yield is around 2%, which should take it to the mid-teens. That's how I am thinking about it. And this will not have, the dividend yield will not have a much of an impact. For example, if you look at in terms of the returns generating going forward as well, because these are not capital intensive businesses. If you look at the leading IT services players, the capital returns has been 75 to 100% of PAT, which they have done even in the past years, and that doesn't have a meaningful impact on their earnings going forward as well. So if I go by this, probably a 10% dollar return, 2% to 3% USD INR, and then a 2% dividend yield. I think that's how I would think about this sector.
So,
Yeah.
so who is going to benefit from these new technologies like AI, a large language model, and this machine learning? What do you feel?
Great question, ma'am. So let me put it this way. I think in one of the slides I mentioned that tech spending can be broadly classified into three types. One is hardware and software, and third one is services. So if you look at any wave, it will be triggered by software, and which would mean that there is an increase, or I would say an improvement in software. For example, if you look at the same AI or ChatGPT, for example, or anything, it came from a software firm. And this is driving the increased adoption of this open AI is, or I would say generative AI, is leading to probably upgrades of their hardware, which is visible in the revenue growth or revenue growth guidance from the semiconductor companies or all the hardware companies. So first it starts with the software, and then when the wider adoption happens, it means there is a need for an upgrade in hardware. And the third one is when the increased adoption happens, when the hardware is ready and the software is ready, how is it delivered to the end customer? That is delivered through the services firms. So it's a wave, I would say. If you look at any tech wave, it starts with a services firm, then it trickles down to hardware firms, and then finally it gets down to services firms. What we are still in the early stages, we are still seeing this impacting the software firms and then the hardware firms. Services firms will come in later. So everyone will get a benefit. That's my view.
First time in the history, top three Indian, top three IT firms have reduced their headcount. So, how do you reduce your headcount?
I think that's a very valid point. I think that is also something which is reflecting in the underperformance of the sector per se, because the near-term outlook is not something which is very great. Because, like I said, the US and Europe are the major customers, contributing to 90% of our revenues. So clearly there is a concern of a slowdown. Thankfully, this concern has been there when we were marketing for the NFO or even before that. So for the past 12 to 15 months, there has been concerns that the world will slow down, the US will slow down, Europe will slow down. But thankfully, there have been positive surprises so far. But until and unless we get a clarity on, okay, the growth has, probably the inflation has reached what the central banks want the levels to be, and then probably we won't see further tightening of monetary policy, then you will see increase in spends from a 3-year, 5-year perspective, because IT transformation spends are 3-year, 5-year spends. So once you have a clarity on the rate cycle, that the rates are peaked and then probably it's going to come down and not go up, then I think corporations will start kicking in with their transformation spends. I think that's when we will see increase in headcount, which will be followed by increase in revenues for the sector per se. Yeah.
Any stock you think in which in hindsight you would like to invest?
Many, I would say. It's always so it's a portfolio, right? At the end of the day, there are things. It's a learning. I think that will continue. There is no way we can say.
Any interesting idea you would like to share?
In terms of the stock,
Any stock you would have liked to invest but have missed and become a multi?
probably internet, I could have been more aggressive. That's what I felt.
Okay.
With hindsight, we have exposure, but probably much more. But there's always in the market, when you don't have an alternative, like when you don't have an alternative, what is doing well today will keep going up. So currently, probably the services space is not doing well. That's why if I look at 2 years ago, it was the reverse. The internet firms were trading well below their IPO price, whereas the IT services firms were doing well. And then the IT services firms, the growth rate started declining, and then of course the stock price didn't do any well or has come down. Whereas the internet story, it's been the other way around. So clearly, probably that's something which we could have done, being more aggressive on the internet space. That's the only learning.
So, if USA get into a recession period, so that could be very easy for exit.
If US gets into recession, I think definitely yes. I think it will have implication across the markets as well. But currently the expectation is that it will not be a recession. It will be a soft landing or a known landing, they call. Soft landing means the growth rates probably get closer to zero and the inflation falls out, but you don't decline. Whereas no landing means you continue to grow at a healthy pace, 1 to 2%, whereas the inflation comes within the target range. So you don't have to do anything, just time takes care of everything. So the narrative has completely shifted from how deep the recession would be to what can we grow at now? Will it be 0%, 1%, 2%? So from that point of view, I think the worries of recession has clearly diminished in my view when compared to what it was a year ago. But in case if the worst happens, if the US gets into a recession, then of course it's negative for the sector as well as the market. Yeah.
Considering your age experience, few investment rules you would like to share?
Sorry?
Few investment rules you would like to share?
See, I think one thing is on timing, I would say. So clearly, it's difficult to time the market. You rather invest for the long term. And second thing is, investing in sound companies is much more important than getting into probably what a company can do in the next quarter or the next quarter. It's very important to probably have a longer horizon, especially when the investors are also aligned that my period is 3 years to 5 years in the market. Then I think as an investment analyst or probably in the fund management team, then the view should always be how should I outperform the benchmark or generate absolute returns on a 3 to 5 year basis rather than on a short term basis. I think only these two would be sound companies, and then not timing, too much focused on timing. I think those two are very critical, I would say.
So, if you can give any personal your example on the timing, because timing the market is a very common observations these people face, because most of the clients want to do timing. So, any of your personal example where you might have initially timed the sort of
I would
any
say-
stocks and something, and you had gone wrong, or something, your personal example if you can share.
I would say
It can help
otherwise.
you. Okay.
Let's say if I think that the fair value of the stock is somewhere close to 105, one internet name which we have, one distributor name which we have, 105, and then the stock is at around 100 levels. So you feel that the downside is not there, whereas upside is not very high, but it's relative to what I see in the other stocks. I see an upside. Then you start adding, and the stock goes down to 90. You keep adding, and then it comes back to 105. So the thing is, had we waited, let's say I want at least a 15% return or a 20% return at that point, and then not added the stock at 100, had it moved up to 105, then it would have completely missed. That's why I feel it's more important to have one's own assessment of fair value of a stock. If it is attractive, add. If it falls, add more. Then that shows the conviction. The market could be, the whole idea is to, let's say, beat the market. So if you have some conviction on some stocks, and then if it turns out otherwise, and if the conviction doesn't change, then probably it's time to double down on the stock. That's what I would.